If you're just joining us now, thank you for coming on. We're going to go through the 5 myths about buying, home buying in today's market. We are super thrilled today. We have Annie Luchella from Fairway Mortgage as our special guest, and she's going to basically debunk a lot of these myths that exist out in the marketplace. A lot of people have opinions, usually, have family members, everybody that has an opinion. They're like belly buttons, right? So that being said, it's important to make certain that you're talking to an expert, and Annie is by far the biggest expert in the mortgage field, and we are super thrilled to have her with us today. So I guess let's just dive right in. Annie, thank you for joining us.
Thank you. Thanks for having me. I'm really excited.
So you want to introduce yourself and kind of like just let everybody know who you are?
Okay. So I'm Annie Luchella, and I've been in the mortgage business for just about 25 years. And my branch is with Fairway Independent Mortgage Corporation. We're a direct lender and have so much available for everyone that wants to buy a house, because we are able to find loan options that work best for them based on sitting down and talking with them and meeting face to face, or we can do Zoom meetings like we're doing now because of social distancing. But my passion's always has been to find the right mortgage for the individuals that are coming to me to sit down, but also to really talk about not only what the different loan parameters are, but making sure that with what they're looking to finance and with those monthly payments every month, that it's something that they can afford and still be able to live their life, and not have a payment that's like really crazy. We educate our clients, and it always excites me just seeing the smile on their face when we get them approved and we get them to the closing door.
Super.
All right, so why don't we dive in? Because there's some 5 myths, and actually we have a couple bonus myths too to talk about.
Yeah. So first myth is essentially your down payment needs to be 20%. Mm-hmm. So Annie, tell us, is that true?
No, it's not. And that myth itself was something that held close to me. I remember when we were first married, the hardest thing for me is that I would watch my friends as the years went on, as we were being married and having kids, and Peter had his own business, and all our friends were buying houses. I'm like, how are we going to buy a house? 50% down. I mean, I wasn't in the mortgage business back then, so I didn't know. And he said, Annie, either they've already had a house or their family gave them money. He said, we're just going to have to wait. You're going to have to wait. And I'm thinking, save 20% of any purchase price. That takes a long time. It's so hard to save money. So the good news is that you can actually purchase a property with either 3 or 3.5% down as a minimum if you go conventional, or you go to a government loan, which is called FHA. If you're a veteran, then you can put 0 down. And if you are in a certain area, which are farther north, like way up in farther north towards the casino or up in past Monroe, different addresses actually fall under the USDA, which are the guys that stamp your meat. And, they let you actually go in with 0 down. There is a bond loan that was available. Right now it's kind of suspended just because of what's currently going on in the current market. But when that is available again, they do allow it, and they allow down payment assistance. So how cool is it? I mean, a lot of people will take their, they'll wait for the end of the year until they get their money back from their taxes, and they'll start to use that towards their down payment. And so no, you don't need to have 20% down.
Well, that's great. That's great.
Mm-hmm.
Now, speaking with you with regard to the mortgage loan programs and people kind of identifying their best options, right? Should they, ideally they should consult you with, kind of showing you all their financials so that you can give them what their best options are, whether they can do the 3%, 3.5%. Well, what's going to be the best thing for them?
Absolutely.
Right? So.
Yeah, no, absolutely. Because a lot of times I have clients that'll call me and they'll say, you know what, if I put 10% down, it's going to, my payment's going to be really, really cheap then versus putting 5% or 3.5%. And everything you have got in your own eyes, in your own mind, what you think is going to happen, but it's really important to sit down and see the numbers. And what's important when I'm sitting down with someone, I want to know, even though we qualify you on your gross income, I look at when we're talking, let's look at what your actual take home is. So that depending on what that payment is with the taxes, it's got to work into your budget. So we have to sit down, and even though someone might say, well, I make this much an hour and I make this, I don't know if you have overtime. And even if you do, sometimes you don't, but there's averages, there's different worksheets that we have to do. So it's really important to provide your 2 months of, let's start with the top, 2 years of W-2s and also tax returns and your pay stubs for 30 days, 2 months of bank statements, just so that we can start to see what we have and what works. We can start figuring out the numbers for you.
Good.
That's great info.
That's great.
All right.
So it's really coming down to the budget. So
Yep.
what's the second myth?
The second myth is, let's see if we can see it.
like
Your
that.
credit should be perfect.
Yeah, perfect credit. Well, true.
That was a
Doesn't
tough
have
one
to be.
to answer. It's kind of like a yes or no.
Yeah, it doesn't. I'll go back first just to a personal reference. Our first house, our credit score was actually in the 500s. And back then, which was over 41 years ago, I know I'm dating myself, I didn't really realize what credit was. And, we were young and dumb, and that's okay. But your credit score doesn't have to be. So right now, there's some changes with credit scores. So 620 on the conventional side, and on the Govy side, you have to be at a 640. And then you're gonna say, but Eddie, or Annie, like, well, I'm not there. I'm lower than that. That's okay. Because once we look at your credit, we have systems in place that tell us what you need to do in order to get your score higher, so you can be at the threshold where you need to be. It's not the end of the world. When the things change again, we can go back down to a 580. But right now you're looking at a 620. We can get that credit repaired. And sometimes it only takes a month or two. So that's why it's even really important if you're thinking about buying a house. We need to talk and have a conversation so we can look at your whole picture so that you are ready and prepared when it's time for you to really say, hey, Eddie, I want to go buy a house. And not where, okay, I want to buy a house, but we haven't looked at anything yet. Because sometimes that 2 or 3 months is going to make you crazy because you're not ready just yet. But you don't have a credit score. It doesn't have to be 800, 700.
So there are, based on their credit score, there may be different loan options available to them.
Mm-hmm.
Some of which you mentioned earlier, right? Like an FHA,
Right.
Which doesn't require a large down payment. I guess it's important to really say it's almost like the options that are available to you kind of are circumstantial to you, right? Like, so it's based on your personal makeup, right? Like, so if you have the 700 credit score, you might have a couple more options available to you as opposed to if you only had 620, right?
That's correct. So for example, if someone comes in and they have a 640 credit score, but when we put in all the factors with their debt and the mortgage that they might be seeking, let's just say it's a government loan, it's an FHA loan, because that has a lot of benefits to it. Because there's a piece that we look at, which are called debt to income ratios. That may not be that might be a great loan for them, but it might not be for someone else that has a 620 or even almost a 700 credit score. They may not want that loan. They may want to go into a regular conventional loan, just for options. But yeah, your options are circumstantial and it's not lifelong. People time. So if you need an FHA loan to get you into one property, and because of whatever your whole makeup is, and then a couple years down the road, you're planning on refinancing because you're renovating the property, you're updating it, and you're then going into a conventional loan. All right. So if it makes sense, you can do that. So credit scores, they're important, but they don't have to be perfect. But your loan can change depending on what your credit score is. And we can make it work.
So now with an FHA loan, there's usually that dreaded like private mortgage insurance, right? The PMI.
Mm-hmm.
So is that?
It's not dreaded. So everybody gets all crazy over PMI. So PMI is private mortgage insurance. It's not the end of the world. I look at it as a gift because if I can get into a house, whether I'm a first-time buyer or not, and I'm paying, let's just say it's $200 a month of PMI. When you add that up, over the course of the year, yes, that's $2,400. But that was, which is also a tax deduction if you're making $100,000 or less. But what's cool about that is that I would rather pay $240 a month or $200 a month than having to put an additional 10% down or 15% down. 10% down on 200,000, it's 20,000.
Right.
It's a lot of money.
So if you take that PMI and you kind of think about, divide that into that difference of down payment you don't have to make, you kind of start to figure out how many months and how many years you would take you to actually make up that 20% down. And by then, your house is appraised at more typically, you've renovated more your property more. So you could, again, you want to refinance down the road, go right ahead, and the PMI will go away. It's a great way to get into a house.
So how much equity do you need to have in order for you to be able to refinance so that you can eliminate a PMI payment?
So the standard is, once you have a conventional loan, when you have an appraisal done by whoever is managing or servicing your mortgage at that point in time, you have to have a 78% loan to value.
Okay.
It's not 80, it's 78%.
Right.
So with an appraisal, and it's based on what's happening in the real estate market around you and how much you've been paying down your principal and balancing out was to what your house is, your house is worth. So with an appraisal, it can go away if you didn't want to refinance down the road or whatever. If you're an FHA, it's a different animal. If you're putting down 3.5%, then that PMI is for the lifetime of the loan.
Right.
The only way out of it is refinancing. But here we go again. Here's the good news. Most people are out of their loans in 3 to 5 years. Either selling, or they're taking cash out of their house, or they're going to refinance because they want a lower interest rate. So everything can change. It's not forever. And I mean, Eddie, you're a real estate agent, and then you've been a broker for a really long time. What do you see? How long does it take for someone typically to start buying up? Or they start at this level and then their second house and then their third house? Like, about how many years does it take for them to start on the average?
I think the national average is around 10 or 11 years old, 11 years.
Mm-hmm.
But it's circumstantial to people's family, right? Like, and reasons
Right.
to move, right? Like, so, you have a family that purchased a 3-bedroom home, and all of a sudden they have an extra, child or two, and then, they need a bigger house.
Right.
So you might have some folks kind of at the lower end of the spectrum where they're going to move in 3 to 5 years.
Mm-hmm.
And then you have others that, perhaps stay there a little bit longer. So
That's the point. They're not in it for 30 years.
Yep.
They're not in it for the life of their life. They're not. People
generally no. Yeah.
So even if you have PMI now, the chances of you staying in that for more than 10 years are slight to none. People finance and they move. So people are changing loans. And it's not like you can just change it with a snap of your fingers, but you're not in it for the life of your loan. So PMI is not dreaded. It's there. There's ways around it. If you wanted, the old fashioned way was you would, if you were putting 5% down, for example, your first loan would be at what we call an 80% loan to value. And then you pick up the balance with an equity line. I kind of just tell people, let it go.
Right.
Rates can go up and down so fast with an equity line, your payment can change drastically.
Right.
So, but that was the old fashioned way of getting rid of that.
Wow. So moving on to the next myth.
What's the next one?
It's a bad time. You can see
Stormy skies.
Stormy skies.
I guess that's relevant to now.
It's relevant right
Yeah.
now, what's going on. A lot of buyers that we had were just like, oh, I think we're going to need to wait, and see what happens. Same thing with some sellers. They're like, oh, maybe we'll wait a little while. So I know with mortgages too, there's been some people who, our buyers have stepped back, as other people have stepped back or have been fearful.
So is it a bad time? Well, if I go back to when we first started buying houses and you buy, you sell, somewhere for investments, Peter and I have probably had 25 different mortgages.
Wow.
Mm-hmm.
That probably we're refinancing also. House-wise, I don't know, we might have purchased, let's just say 10, for example. You're talking a period over 45 years. There's a lot that has happened in 45 years. Is it a bad time? No, I don't believe so. If you listen to the different economic, I can't say the word, it's not coming out. Economists, there's my word. The economist, as they're talking, like, no, this is not a bad housing market like it was in 2008.
Right.
Not at all. That was based on, that was a housing issue. That was because of the type of loans that were, being closed at that time. And it was also about houses. I remember appraisals coming in, they were crazy. I mean, they were going up 25,000 like in weeks. It was craziness. So that's not what's going on right now. This is not a bad time. All the economics economists have also said that in the next 2 quarters, it's going to be amazing overall. So is this a bad time? Not at all. Not at all. It's a great time, especially because inventory is low. So sellers can push a little bit on the price. And for the buyers, I mean, there's a lot of great properties out there that need a lot of work that you might get a little bit undervalued. I mean, that's Eddie's expertise. I don't know, Eddie, do you think it's a bad time?
So the real estate market is largely driven by supply and demand, right? So and prices kind of go where according to that, and what we're seeing right now is there's still strong demand. We've been tracking it since the whole pandemic hit, and it seems like week over week we've got a ton of properties going under contract. Unfortunately, a lot of sellers are fearful and they're not getting their homes on the market. And as a result, there's still a few homes to choose from. So, if a property looks, it is prepared correctly, meaning, it looks beautiful when they put it on, it's going to go to multiple offers, believe it or not, even during this time frame.
Right.
We've had a number of properties that went under multiple offers, some of which we lost, right, for those buyers because they were not willing to go above the asking.
Right.
So yeah, I think only time will tell. But as you were talking about a few moments ago, the JP Morgans, the Goldman Sachs, the people that actually advise a lot of folks about where to invest their money are all tracking what they expect to happen with the economy. And they're all saying that we're looking at a V-shaped recovery. So with a V-shaped recovery, yeah, we're going to have a down quarter, because everyone's stuck in their homes. Right. But perhaps as things start to, open up and states start to open their doors and non-essential businesses start to really open back up, I presume that, the market's going to continue to go, and there's going to be a flight also to kind of our area right here in Connecticut, right? Where, there's going to perhaps be a number of folks who live in New York or live in like high-rise apartments who don't want to necessarily be so close to their neighbors anymore, and they want space. And the next best area is going to be Connecticut, right? So
we've already seen some of that. It was just like in 9/11, the same thing. There was went up our way. So no, is it a bad time? No, absolutely. And the other thing you have to think about if you're renting right now, when is it, how long do you think it's good to be renting? When your landlord is going to be the one that's going to really determine what you're paying. And what if he puts a house on the market? Now you're going to have to go look for someplace anyway. So you should be, and besides what you're losing, on yourself, there's a whole other, calculation for that. But looking at getting yourself, starting to put together a plan. You want a house, you should have a house. It's the American dream. So let's sit down and talk and put together a plan so that when it's time for you and you're ready, if it's not right now, you'll be all set and ready to rock, whether it's money, whatever it may be.
Look, I think when you look at how wealth is built in the United States, most of the folks that are the wealthiest have invested in real estate, or they're heavily invested in real estate. It's especially since stocks are somewhat volatile, right? Like they can go down to zero. Real estate never goes down to zero, right?
No, it doesn't.
You're always going to have some value retained there. So there's you can never sharpshoot a market in terms of knowing whether or not it's going to be the absolute bottom or absolute top. But I think over time, right, like you're gonna do well if you hold on to real estate. If you look at, past recessions, yeah, and if you were in the market and it just held firm, more than likely you recovered all that equity and, and are ahead of the game. So.
Right. And then, you've been managing properties and been in the real estate business for, I don't know, probably since you were born. I mean, seriously, Eddie.
So
I've seen it. Come on. And you are. I mean, if someone wants to really build their wealth and you start off, I mean, how great is it to start off with a multifamily? You use an FHA loan to get into it with 3.5% down, which is way below what you would normally use. And you keep it really nice. So because people want someplace that's nice and secure and safe. And then down the road, when you saved up some more money, you rent out your unit and now you move on to your next property. And you've got a property that is an investment with only 3.5% down, and it could be 2 or 3 floors.
Sure.
You watch and you just build, and which helps you into retirement also. So, and you're the king at that. You are.
Oh,
You are. You've
I've
done
had
it forever. Come on.
We've had a lot of clients that we've helped do that very thing, with your help as well. Where, they were smart enough their first house was a multifamily, and then they leveraged themselves to the single family afterwards. And they've created themselves some additional wealth as a result of it, right? So
Absolutely.
So the next myth we have on the table is still kind of talking about mortgages, and I'm going to ask you, are pre-qualifications the same as pre-approvals?
No, absolutely not. And I love when people come and say, okay, Ian, I need to get, so-and-so told me to call you. I need to get pre-qualified. There's a big difference between a pre-qualification and a pre-approval. So a pre-qualification basically means that we've pulled your credit and you've told us what your income is and what you have in assets, but we haven't verified anything. So it's based on what you've told us. And I'm not calling anybody a liar, but by the time we do the calculations that are required, the way we have to do it, a lot of times what you think you're making or what you have as income is not what actually can be utilized the way you think it can be. Like I have someone right now that is buying a house, and because he rents his house out by the rooms, it's a 2-family, and he wants us to be able to use the leases because he has 5 different leases because it's all based on bedrooms. Yeah, I know. So, but my income works, I said, but not in the real world because it's a 2-unit.
Right.
It doesn't work that way. It's just, and so anyway, fast forward. So different things that we think that'll work, and the house that they were buying, he goes, but I can use the income from that because there's a 2nd floor. Yes, there is, but it's an in-law setup. It is not a 2-unit. So the way we calculate things are going to be different. So it's so important to be pre-approved, which means we've looked at your income, we've looked at your assets, we've documented everything, we've done the calculations, so we know exactly what you can and cannot do. And that way there's no disappointments. And this way, when Eddie takes you out, he knows exactly what you can afford and what you can't. And we've already had that conversation and we've already figured that out.
So in that vein, like how does a consumer know what they got? Like, is the language on the letter going to be different, or
the pre-approval?
Yeah. So if I called the lender, not you, of course, but let's say that I called,
Quicken Loans.
Quicken Loans, right? Yeah.
Right.
You just call Quicken, and they're like, yeah, tell us how much you make. So it's just a phone conversation, and then they send me a letter. So if it's just a phone conversation, should I assume that it's a pre-qual, like a pre-qualification? Or?
That would be what I would call a pre-qual, and real estate agents that are seasoned know better. They will make the phone call to the loan officer and make sure that they have been really pre-approved. If it's only a pre-qual, if they don't document anything, that letter is supposed to say pre-qualification. It can't say a pre-approval.
So the consumer should really know that if it's just a phone conversation, they haven't asked you to
send any
financials. They haven't asked for you to share. What's the typical things that you're going to ask for to get a pre-approval together? Is it going to be?
It's easy peasy. It's really simple. When we have that conversation and after we have spoken, our phone app, we zoom it out to them. It goes to their phone and to their their computer, but they're going to want 2 years of W-2s. Depending on your job, we may request 2 years of federal tax returns,
Mhm.
30 days of pay stubs, 2 months of complete bank statements, all pages, all sides.
Okay.
And I'm underlining that. Your driver's license. And then now, if you've been divorced, I need your divorce decree. If you had a bankruptcy and it's still within the 7 years, I'll need all the bankruptcy paperwork. So, and once we start going through it, there's always a lot of pieces that we might have to come back and say, okay, can you give me documentation for this? You know, so it all depends, but those are your basics that you need.
Now, I know your office has really been virtual for quite some time, right?
Mhm.
So I don't necessarily need to bring you those documents
Nope.
all in person. You could pretty much send them to you.
Yeah, it's really cool. On the phone app, it has a scanner. And after you put in your information in the bottom toolbar, if you open up the scanner, you just click on W-2 and it has even crops it for you. And you click for both years, hit send, it disappears out of your phone, and it's out of your camera, it's gone, and it comes right into our system. And
That's totally
we're
secure.
all through a scanner. It's totally secure, totally encrypted.
Oh, okay. So it'll.
People that still want to drop it off, that's fine. But we like to get it because once it's in my system, it's just really easy to read. And then for us, but also for the underwriters, and it's virtually paperless. It's really cool.
Okay. So I could, if I was sending you my pay stubs, I could just scan them right from my phone. They're not going to get saved to my phone. They're going to go straight to your
You're going to go straight to the
server. Okay.
That is correct. Even when you fill out the phone app with your basics, like your phone, your full name, address, social, birthday, where you work, and so on. Once you've completed it and you hit, send, it completely disappears out of your phone. And you've created your own username and password that is unique to you so that nobody else can break into it.
Okay. So you're getting your information like that. So if somebody wanted to start the process, they would, you're going to have a conversation with them and you're going to kind of point them to the app so that they could start that process of sending you their documents.
That's right. And then once that's done, since right now we're meeting everybody through like Zoom meetings virtually like we are now,
Sure.
We'll set a time and we'll meet, because I like to meet all my clients. I like to have a full conversation like we're having now.
Right.
Very personal as far as I'm concerned. There's a lot of information and it's also help everybody understand better. So we'll set up a Zoom meeting since we still have social distancing going on, and I'll be able to share my screen so you can see everything that's going on. And we'll talk about the mortgage process and what you should expect and what the end game will be.
Okay. So that the next myth that was up was actually, I think, timely because it talks about myth number 5 is, do I buy a home for the maximum that I qualify for?
Right. So if we qualified everyone, and you could, some people do, when we look at your total income, your gross income, and also, of course, what you have as money available for down payment and closing costs, because that's also going to offset what you can actually afford. If I hit you on the max that you qualified based on the guidelines, you're going to find that you're not going to have a whole lot of money left when at the end of your month, as you're paying your bills. And because what you take home is not what your gross income is.
No.
When I'm working with anyone, I first figure out what their take home is monthly. And from there, we subtract out their debt, that's credit report. And then the other things, what about your groceries? What about your car insurance? What about, back then, your gym dues? What about your cell phone? What about your, I'm trying to think of other things we put on there, throwing it off the top of my head, because I always write it down. Your gasoline for your car. All right, so when we add those all up, and then that's going to give me an idea of what's left of the month. Well, let's say it's $2,000, and the house you want is going to be a monthly payment of $1,800 a month. I'm going to talk to you about that because having only $200 left over a month is a little tight.
Sure.
Scary, and because in a house things happen. I mean, what if you need a new hot water heater, or you want to go out to eat. If I only have $200 left at the end of the month,
Yeah.
Not gonna leave you
You're
for
not going
much.
to be able to buy groceries if you have
Mm.
family.
and then the wife ain't so happy.
Right,
And what about your makeup? What about getting your hair? What about your nails? All those things that we've always done. Those are all part of the things that factor in. So we talk about that, and some people have changed their budgets. I mean, some people that eat out a whole lot, and I've seen where they're spending on a monthly basis a whole boatload of money just on going out.
right.
Crazy. And they're like, oh, maybe we should cook. Yeah, let's try that. And then they start to budget and they start to see what a difference it is.
Sure.
That. So no, I would never qualify anybody on their maximum. Absolutely not. Because you're
It's
gonna die.
kind of funny because we've been working together for quite some time, and I've heard you say like, hey, you don't want to choke yourself, like you don't want to be in a situation where you're so tight where you're not going to be able to make you go out and have like basic necessities, but so realistically have that conversation with somebody, perhaps with their spouse, and if their spouse is not on the loan, there may be other income coming into the property or coming into the household, right? That you're not taking into account, but
But I work off of that. If they're not going to go on the loan, for example, let's say they have their credit's not so great. So I will factor when I'm with them, all their total take home.
Sure.
And we work it from there because that's only fair.
Okay.
Yeah.
So you're looking at kind of like the holistic picture of the household, and you're like, hey, you're going to be allocating this much, and you're almost like cross-checking them to make sure that they're not going to be choked, right? Like they're not.
Absolutely.
Yeah.
Because I've been there. I've done it. I'm taking this from my own experience.
Right.
Mortgage business for almost 25 years, but I've made all the mistakes. So when I'm meeting with someone, I talk to you and treat you like family. I'm going to tell you, you may not like what I tell you, but I'm going to talk to you just and say, this is the reality. I've done it where I've used every penny we had for a down payment because I wanted this particular dream house. I've had it where, so now I have there's no money left in our account, and that's pretty scary. I've done it where the mortgage payment was so ridiculous that every month you do skiat, you choke. It's no fun.
Yeah.
All right. You don't want that pressure. Then the house isn't fun anymore. You want the house to be able to enjoy it and enjoy your lifestyle. You don't want to be married to it. So I've done it. So that's where I'm from.
Good. So we've got some bonus myths, which are pretty awesome. The first bonus myth that we have is choosing a lender based on the lowest advertised rate.
Okay. All right. So is that going to make for a good loan? So they want the lowest rate. So the first thing is everybody wants the lowest rate that's possible, but rates are based on your credit score, the type of loan you're doing, the type of property that you're buying. Is it owner occupied? Is it investment? So there's a lot of pieces to the puzzle. So
Right.
Your sister got this particular rate, but what you're doing is completely different. So you cannot make a comparison. But lowest rate isn't always the answer. You're looking at service, you're looking at communication. How many people we have spoken to that have left a lender because it turned out to be a disaster,
Sure.
because they were told that they were going to get this rate, and all of a sudden they start to disclose, and all of a sudden not only is it not that rate, or even if it is, the cost for the rate is not what they chatted about over the phone, and there's always a reason.
Right.
No, when you're picking a lender, you need a lender in the area so this way their appraisers know the area, the realtors know each other with the mortgage person because they work together as teams or together in other loans, but so that you have good communication. All right, not only just the first time you meet with them, but during the process, that the lender is getting in touch with both sides, both realtors, with the attorneys, that your loan is going to be approved on time and closed on time. You're not going to miss those deadlines, that when they're calculating your income, they know what they're doing.
Mhm.
So that what you think is your income, then all of a sudden they go to bring it to underwriting and underwriting denies you. We don't do denials. I don't want you to go through that because that's heartbreaking, especially when you have a house that you really love. So the lowest rate, I would say you get what you pay for. Do we overcharge people? No. Do we have low rates? We beat everybody, but we're really good at what we do.
So you're kind of looking at it like you're the Nordstrom experience, right? Like where you walk into Nordstrom, you're not necessarily going to pay cheapest, but you're going to get an excellent experience, right? Like
Exactly. They're going to take care of you. You're going to be in person. You're not going to get lost in the whole mall like with a lot of the online companies where you're just a number. So you talk to Johnny today and you talk to Mary the next day and so on and so forth. And if you look up their NMLS number, most of the time, 6 months ago, they were at Starbucks flinging coffee. Oops, where's the experience?
So that's important, because I think that's, so if you call this big company, you don't know if that person's got any kind of a track record, right? Like they might have started the business yesterday.
I mean, everybody has to start, and I get that, but the lowest rate doesn't guarantee you anything. Because if they can't close your loan, what's good is the rate?
Yeah, the rate's not worth anything.
Pretty much, I'm not saying you have to be handheld, but you want someone that's going to protect you and make sure that they're going to guide you so that your end will be what you're looking for. And that is the mortgage on the house that it's your dream house that you want.
Okay. So really it's important to not just shop the rate, but make certain that you've got credible people that are working with you.
Absolutely.
That they're going to guide you through that process and make sure that you get to the finish line, because the other guy might be advertising a low interest rate, but you may never close.
Right, because it's the back office that's also important. It's not just the loan officer. I mean, it's all right. Once the loan officer does their job, it has a setup, and we have a full team here, and everybody knows what's going on, and everybody works together because the end game is to bring you to play, and everybody communicates. So if I may not be able to pick up the phone because I'm on the phone, someone else is going to pick up that knows about your loan, either my assistant or one of the setup or the processor, but there's a whole team that all knows each other, and we work cohesively to get you to the end where we want you to be, and that's close, clear. So you need to have a good team, and we work with you, and we're a great team. We know your attorneys. We all work together. There's a great flow, which is what you want. You don't want to have that horrible nightmare process that people have heard about before in the mortgage industry.
Right. And I think too, I think the experience is important, particularly as you start to get challenges in the process, right? Every file, every purchase is kind of unique. And some of them have had, they have challenges, and some are small challenges, and some are huge challenges. And if you have somebody who's not experienced, they're not going to know how to, to deal with it. And then they may just, their way of dealing with it would be, hey, let's just decline the loan.
Right. Right. Yeah, you got to be able to think out of the box. You have to be a solution, a finder of solutions. You have to be. That's what this business is about.
Yeah, and it's not like we're making up things. You've encountered so many different challenges that you know how to hey, that's no big deal on my part. I can already have a solution for you. And you're solution oriented, right? Like you're gonna find them a way to work around that so that they can get to the finish line.
Yeah.
So and I love how you say this a lot, and I know it from personal experience. Cynthia and I both know it from personal experience, is that you treat everybody like family, right? So
yeah, absolutely.
So because of that, it's like, you have a vested interest in making sure that they get to the finish line.
I do. I take it personal. If someone comes to us and they want us to help them with the financing of their mortgage, they're giving me everything about their life. And so it's important for me to take care of them. So that's how it is. I can't do it any other way. They have to be treated like family.
Yeah. So our next myth,
what's that, Cynthia? Is actually one that I hear quite a bit.
What's that?
Is you cannot buy a home if you have a student loan.
Oh, student loans. Yeah, student loans are fun.
Student loans.
It's really interesting that people think that they can't buy it with student loans. You most definitely can. Student loans, even if they're in forbearance, we will calculate, we have a calculation that we use that when your loan comes out of forbearance, so that we make sure that, again, like how I told you, I only use your take-home income when I'm calculating what you can afford. That's part of the whole picture. And if you already have a payment that's going on, again, you're already in that payment, so we're gonna calculate it into your overall debt and have your income and then take the mortgage, let's put it all together. Can you afford it? But yeah, people do it all the time. Absolutely. You can most definitely get a mortgage with a student loan, or 2 or 3 or 4 or 5 student loans.
Well, I know a couple of people that have that problem. So it's like, you know, they're always fearful. They're like, oh, I have a student loan. I have to just pay that off before I can move and do anything. So,
Not true.
you know,
Not true.
a lot of times we tell them, hey, you know, you still can because it's part of your overall budget. You've been budgeting
Precisely.
it already.
Precisely. So again, when we're factoring out their numbers, it's just looking at the whole picture. Student loan debt,
Yep.
it's going to cost you on a monthly basis, your other debt, your mortgage, your income. If this number works and there's money left over for you every month,
Yeah.
it's just free money that for anything else that comes up, then absolutely go do it.
Cool, cool.
Cool.
Well, that,
So
we're happy that you debunked that, because there was a number of folks, like Cynthia said, that were concerned about being able to buy with a student loan. Our last myth that we have, or last bonus myth, is Zillow says it's true, so therefore it is.
So Zillow
we have
is,
both sides. We can both
Yeah.
talk about
Really?
that. Or-
so Zillow is the god of real estate, is that it?
Mhm.
Yeah, not so, absolutely not. Eddie and I have gone through this many times talking about Zillow, and people will use it as a, hey, that's live TV, it's good, Cynthia. Zillow is not the god of real estate. Zillow is not the god of loans. They are not the god of values. They're not, you could use it as a jump off or get a basic idea about who you need to speak with is your real estate agent when you're looking at values or what a house is worth. If it has to do with, Jess, I need you to fix this for me. I think, there you go, dismiss. There we go, sorry.
There.
Good.
So I'm sorry, I'm a little distracted, but every time we're on a Zoom call, the dog needs attention.
It's like a child when you're on the
Yeah.
phone, but Zillow can't tell you what the best loan for you is. They can't give you the best loan rate. They can't tell you the value of the house. They're just, I mean, can you imagine your brand and everything is on a guess?
Yeah,
Like, yes.
Pretty much, yeah.
pretty much.
Pretty much.
And people pay for those guests. I'm going to be on Zillow and I'm going to pay this. So, okay,
Yeah.
real estate. What do you think, Eddie?
I agree, and it's simply because there's no way that they were going to be able to really pinpoint the value of a specific house without entering into it.
Right.
That might hold true perhaps in areas where things are really cookie cutter, right? Like you had 3-bed, 2-bath. It's a complex, and it was all built the same. Nobody made any changes to their homes. Hey, that might be true for a little while. But you start adding in nuances like we have here in New England, right? Like every house is, perhaps may have been built at the same time. However, things have been changed, right? So somebody modified their kitchen, somebody upgraded
That's right.
their bathrooms. Somebody added more square footage to the house. So not all square footage is the same, right? Like, you might have somebody whose house is immaculate, and therefore their house should be worth more. And then the other guys is, not taken care of, and their house is going to be worth far less. I think it's a good jump off point to have a conversation.
Right.
But then you really got to get in front of someone who's an expert in the field. Whether that expert's going to be an appraiser, whether that expert's going to be a mortgage loan officer like yourself, or a real estate agent like us. We're looking, we're in the market every day. We see what's going on. And then we can kind of advise you appropriately as to where values are. And I think, the bad thing about Zillow is that they keep a lot of their information on there for years. Like their houses are always listed as active and they're not.
Right.
So they're an advertising portal. So they're
Precisely.
making money on how many people visit their website, and they can generate advertising dollars. So, agents are paying to advertise on their system. So, that's essentially the reason why they exist. They're just kind of an advertising medium.
But I'm sorry, go ahead.
we're forced as agents to advertise on their platform because we know that's where a lot of people are.
Right.
But you know, in the end, when we're educating them, or you know, we're typically telling them, hey, you got to get off that system, and then we're putting them in our system so that they can get the most relevant information.
Correct. That is absolutely right. You know, it's just like if you go and you just have that conversation with, let's just say, an online lender, and all you did was have a conversation about your income and assets. Okay, you're pre-qualified for this amount. It's a guess.
Yeah.
You have to sit down with someone that truly knows their business. Eddie truly knows his business. You've been doing it. You know it inside and out. You can go into a house and you can say, okay, I think you could sell your house for this much because here's the comps I've come up with and here's my reasons why. It's when we do a mortgage, the bank, we always have to have an appraisal. We don't go on Zillow to get the value.
No.
You know, so it's like you said, it's a great jump off. It's a great place to have a conversation, but everyone needs to understand the brand is Zillow, but they are an advertiser. And again, it's a great place to advertise. It's a great place to get information, but no, they are not the god of real estate.
I mean, I guess I'll leave this with the last point is their former CEO sold his house and sold it for in California for more than $1 million more than what it was listed for on their system. So their values can be off. On the
That's just a little bit of an offness there, yeah.
Just a tiny bit.
So yeah, and they have a lot of disclaimers that are on their system that say, hey, you know, we can be off as much as 25% in some areas. So
In some areas, or $1 million.
Yes.
And his-
Or $1 million.
Yeah.
Yes.
So any parting words as we wrap up, or?
Any parting words? So for anyone that's thinking that they might want to get out there and start buying, you're tired of renting, or maybe you want to move out of your current property and move on, honest and truly, give us a call. We'll be happy to work your numbers for you so that this way you can sit down with Eddie and he can map out for you based on what we've discussed that works best for you number-wise, between what your assets are and what you want to use for the purchase, or what your actual income is. Eddie can put you on the right path. And, you know, Eddie is a killer negotiator. He is able to, it's so true. He gets done for the clients because you treat all your clients like family. He just goes in and he gets done what needs to get done. And you need to make that phone call and sit down and don't worry about that your sister's brother's mother's kid is a real estate agent. Forget that. You need to go to someone like Eddie and go to Eddie, sit down with him because he knows his business. He's a true professional. He has the knowledge. So you know what? Don't wait. Let's figure it out. Let's figure out what you can do.
Great. I mean, I feel the same way about you in terms of how you've been able to take care of so many of our clients. And I gotta, you know, I say it repeatedly in our business networking meetings. You know, I can't count how many times you've got me out of jams, right? Where, you know, someone had a different mortgage lender and, you know, all of a sudden we brought the information to you and you were like, yeah, I can do it. So, you know, you're the queen of solutions, right? Like you always look for a good way to make certain that they can get, you know, the house that they want, right? So, and you know, I love working with you because it's, you know, it's really just about that. I know they're in good hands.
Thank you. And I feel the same way with you. Absolutely. We're a good team.
So super. I mean,
Is there anything else we have to discuss? Give us a call.
Yeah.
Absolutely.
And what we'll do is we'll put all your information in the comments
Okay.
below on Facebook. And if anyone wants to reach you, they can definitely reach you.
That would be awesome. It'd be
Yeah, I mean,
wonderful.
you're just looking
We
at
got a couple
some of the
kudos.
comments, like you got other folks that you had helped, and you know they're basically, you know, singing your praises as well. So
Thank you.
so that's phenomenal, and thank you so much for your time, Annie, today. And
This was fun. Thank you.
we'll look forward to working with you some more.
Yep. And
Sounds
hopefully we'll
good.
do this again another time.
Yeah.
We'll
Got
pick
it.
up some other myths too and have you answer.
Okay.
Yeah.
Sounds good. Guys, thank you so much. This was fun.
Have a good
You're
one.
welcome.
All right. Have a good one, guys. All right. Bye-bye.